Targets can't create inflation. The Fed is discussing whether to raise its inflation target. The Fed is frustrated. It thought it had the power to create inflation, and it appears it does not. Other central banks, such as the European Central Bank and the Bank of Japan, well, they're frustrated too by their inability to create inflation. Indeed, in the U.S., core inflation, that doesn't include food and energy, but core inflation has been stuck around 2%, plus or minus a mere 1% range since 1994, or for 25 years. We have seen stocks go up and down. We have seen employment go up or down twice. We've had a mortgage crisis. And in the era of quantitative easing, or QE, along with a long period of near zero short-term rates, we still had virtually no impact on economic growth or inflation. Really and truly, the data is clear that the Fed has had little to no influence on the inflation rate for 2.5 decades. There is no longer any on switch that central banks can pull to create inflation. Now, the latest idea proposed by the president of the New York Fed is to allow a higher inflation target, at least temporarily, after a period of undershooting the current 2% target. Our perspective is that raising the target inflation rate will not raise inflation expectations. Raising the target rate of inflation is simply Fed speak for telling market participants that the Fed plans to keep rates on hold until inflation rises above 3%, regardless of how tight labor markets might seem. Now, if the economy decelerates, and the Fed doesn't think it will, but if the economy decelerates, as it may do in 2019 according to our scenarios, the next rate move by the Fed could even be a cut. And setting a higher inflation target simply doesn't matter at all. I'm Blue Putnam, Chief Economist, CME Group.